Good morning. It's Monday, the 24th of June, and this is Govindraj, Ethiraj, broadcasting and streaming from and headquartered in Mumbai, India's financial capital. Today's take, and it's a quick one. Ease of doing business is a term that we use often. A quick glance at the recent announcements from a goods and service tax meeting between the central and state governments came up with moves that only tells you how difficult it is indeed to do business in India, and how once implemented, rolling back laws or simplifying them is tougher than extracting a proverbial tooth from the tiger. Now, the GST concessions offered themselves, like exemption in some services offered by railways, hostels, milk cans, cartons, and solar cookers, are so diverse and so wide that each of them suggests that a specific lobby has triumphed rather than merit. Just to remind us all, the GST came into effect only in July 2017, and by any explanation or definition has got progressively more complex and challenging to navigate every month since then, it would appear. I would really like to hope that the government would reduce goods and services tax, which is at 28% on air conditioners, since there is more than sufficient evidence to prove that they are not luxury and that people are dying like flies from the heat waves. Please do not think of the air-conditioned drawing room elite image. Rather, think of those working in small factories across the country which make up the bulk of manufacturing and employ some 90% of labor. Yes, of course, providing cooling is not going to be easy or affordable for many, but a lower tax regime should surely set it going in that direction. Anyway, some of the other pullbacks, like waiver on interest on penalties on tax demand notices issued under a Section 73 of the Goods and Services Tax Act between 2017 and 20, only illustrate how long the arm of the taxman is. That is, if you're not accused of fraud, suppression, or misstatements, and then only if you pay up by 2025 March. Now, there is much more to all of this, and there are demands from the small and medium enterprises which we will come to. The bottom line is our tax systems have to become simpler. Every individual transgression or fraud by an individual or company in a country with millions of businesses, small and large, leads to laws which actually make life tougher for everyone, since it's usually a blanket response. Small enterprises struggle under the weight of compliance, and we must think of them when framing laws, not just the mighty conglomerates with armies of chartered accountants and tax consultants to manage their problems. And now on to our top stories and themes for the day. The stock markets are holding on to highs. The next cues could be global if they were to go to new levels. New GST announcements once again expose the regulatory complexity. India is importing steel for the first time in many years. Why and how this impacts local industry. And for India's SR Group, it's never say never in steel. And India's small enterprises want a piece of the production-linked incentive or PLI cake to drive jobs and manufacturing growth.
This is the Core Report with Govindraj Ethiraj.
Stock markets search for fresh cues. The markets, as we've discussed over the last week, continue to search for direction, and while the union budget will provide some, it does appear that it will be tough to do anything beyond some tax cuts. Not that tax cuts are not good, but individual tax cuts are unlikely to have a major impact. What the market would like is, of course, lowering of capital gains tax on sale of shares, which, of course, is politically tricky to do as well. The general mood amongst regulators, which also are part of the government, is, and quite rightly so, that there is too much froth and embedded risk in the financial markets right now, even if nothing is actually going wrong on the face of it. For example, how India now represents some 80% of world futures and options volumes. And the figures in terms of contracts have been rising and very sharply in the last year. Back in the markets, the indices were lower on Friday. The BSE Sensex closed about 270 points, down at 77,209. The Nifty 50 fell about 66 points to about 23,501. Foreign investors, as we've been projecting and predicting on the Core Report, are now back in the stock markets after the election results were announced. They've invested about 12,000 crores in Indian equities so far in June, but they are net negative in 2024 in equities since there were substantial withdrawals in April and May. Total outflow, according to Business Standard, is about 11,000 crore rupees in 2024. That's the net outflow, and also from data with depositories. The interesting thing, and now I'm saying this more anecdotally because I will need obviously several months of specific data to make a definitive statement, is that the actual flows of foreign investment are not commensurate with the steady flow of bullish brokerage reports, some of whom, of course, are projecting a dreamy future so far out that some, if not many of us, will not be around to see them. Be that as it may, the medium term is bullish, except, of course, for valuations, where again it depends on who you speak to and on which day. By the way, the Wall Street Journal is questioning AI chip major Nvidia's valuations and asking whether there are similarities to the dot-com boom of the 2000s. So if the WSJ can question Nvidia's valuations, surely we could also question some of the valuations we are seeing here, if not many. So the big cues, of course, will come from Wall Street, including from the US GDP numbers for the March quarter on the 27th of June. The GST Council's new rules. India's finance minister on Saturday announced biometric-based Aadhaar authentication to check fake invoicing. This is going to be a rolling out of biometric-based Aadhaar authentication on an all-India basis, which will help combat fraudulent input tax credit claims made through fake invoices in these cases, the finance minister said at a briefing after the 53rd GST Council meeting over the weekend. Now, there were many other announcements I've already covered in the opening take. Suffice to say that it's depressing to note that we have a GST category which covers hostel accommodation outside educational institutions to the tune of 20,000 rupees per person per month, where an exemption can be availed only if the stay is up to 90 days. And of course, I forgot sprinklers for fire and water, which will be now charged at 12%. Any reporting in all of this, or rather error in reporting, is mine, though I doubt there will be any. And then there are new rates for cartons and milk cans, regardless of the metal used in them, we are told. How India's steel imports are rising. Now, India produces roughly 139 million tons of steel, and most of it is consumed by growing infrastructure and construction sectors, among others. However, for the first time in many years, imports have overtaken exports, suggesting not so much demand but price shifts. India's domestic steel industry, by the way, has been clamoring for higher import tariffs, a plea that does not seem to have been heeded or is not reflecting in the numbers. Meanwhile, imports rose, according to a new report from rating agency CRISIL, to about 8.3 million tons in the last year, which was about almost 38% over the previous year. A lot of that steel came from China, South Korea, Japan, and Vietnam. Yes, Vietnam, in case you hadn't noticed already. Vietnam's steel exports to India, the numbers are of course small, but it rose 130% year on year. Amongst the types of steel, it's hot rolled coils and plates, which were the most imported steel types, which account for about 62% of import volume, which in turn almost doubled. Now, there are some shifts, for example, a decline in imports of some specialty grade steels because of domestic manufacture linked in turn to production linked incentives or PLI schemes. The interesting thing is that India is exporting and importing steel at the same time, reflecting the price shifts and, of course, the seasonal behavior of trade. So I reached out to Sehul Bhatt, Director Research of CRISIL Market Intelligence and Analytics, and I began by asking him why India's imports were going up in this form.
So I think, Govind, if you look at the kind of a trade dynamics over the last decade, kind of quantum that we have imported in the last fiscal, that has substantially gone up compared to the last 3 to 4 years of import that we've done. And in fact, we've turned that importer, as you rightly started with. The only observation here is that the quantum is still lower compared to the peak that we observed in FY16. However, there are a couple of reasons why we see imports rising. And up to an extent, we see that as a point of concern or caution from an industry point of view. Point number one, we do not see that the import is because enough supply is not. In fact, while the growth momentum on the demand side has been much, much stronger. In fact, if you look at the growth rate for the steel consumption over the last decade, previous 3 years have seen a healthy double-digit growth rate every year, which is also a positive sign for the industry. At the same time, capacity addition has also been picking up. And we see addition continuing at least for the next 4 years. So in fact, our view is that within 25 to 28 fiscal, next 4 years, the capacity addition to the tune of 55 to 60 MTPA is also likely to happen, which is almost 32 to 34% addition compared to the capacity we already have as of now. The prime reason here is that as and when the spread between imported steel and the domestic steel changes and it becomes more favorable to have imports rather than procuring it domestically, I think that's the reason why I think you would see a typical period of 6 months or 9 months or in some extent up to a year where your input quantum keeps on increasing. So let's shift focus towards not India now and let me look at global dynamics first. If you look at the consumption in China, as we all are aware, it has been a little sluggish. And despite that, the production has not significantly reduced. So that means they have an excess capacity where They are looking and exploring the destinations for exports. We believe that somewhere this trend of excess production and hence their call, or I would say a view of reducing the margin but continuing the quantum of export is what is pinching us in terms of lower production cost with which we are fighting as far as the domestic capacity. If you look at the trend of last 6 to 8 months from the profitability of Chinese millers, in fact, between October to March for the 6 consecutive months, they were operating below the traditional profitability line. And in fact, for the first 2 months of the fiscal, April and May, the last 2 months, in fact, we have seen some uptick in terms of that profitability. So we believe that with that uptick coming in terms of their own demand, some kind of a price parity should have come in. But that's precise reason and the prime reason why I think the imports in blocks of months, wherever the yield of the spread reduces, I think we see influx of that going up significantly.
So at any point of time, we are obviously importing and exporting. So let's say we imported 9.6 million tons last year, but we also exported 8.5 million tons. So obviously different batches of steel are being imported and exported at the same time, and maybe of different varieties as well. So in a broad sense, so does it have anything to do with the kind of steel that we are wanting and we are therefore importing, or is it purely a price factor that's causing us to either import or export at various points of time?
So, Govind, I think not essentially the category of steel or the price point. I think the destinations are quite different. And as you rightly mentioned, I think if I bring in the perspective with regards to quantum of last fiscal, we imported 9.6 million ton of steel, but at the same time, we also exported 8.5 million ton. However, if you look at the import basket, that means the countries from where we import, I think it's led by South Korea, then China, and then Japan. And Vietnam has also seen significant contribution coming into our import of steel. At the same time, if you look at the kind of countries that we export to, clearly European Union, Vietnam, and UAE are the major destinations. In fact, the share of EU in our overall export has gone up significantly. So I think these are dynamics with regards to from where we source. These are the kind of destinations which we cater to as part of our export target markets.
Right. And, the figure for overall steel consumption is 139 million tons. Now, how much of this, or rather, how does this contrast to the capacity that we have in India? And what's your outlook for, let's say, the next year or two?
So we believe that from the equilibrium of demand and supply, the industry is well positioned and is in a bright spot as far as the demand outlook is concerned. Obviously, with the fact that we saw a very strong growth momentum, 12% plus CAGR for the last 3 years, that means we are already working on a very high pace. And on top of that, the underlying growth drivers, be it building and construction, infrastructure, industrial plant and machinery, and automobile. These are the four contributors that drive the volume for steel. All of them are likely to continue the kind of growth momentum over the next 4 years. So in fact, we have a view that steel demand from a medium-term point of view is likely to grow at a CAGR of 7 to 9%. So that's a plus point why some of the companies have continued putting in capacity addition and executing that on ground for the last 3 years, and that plan will continue at least for the next 3 to 4 years. The equilibrium is monitored by the industry in the form of utilization level. And we believe that last fiscal, we were somewhere around 82 plus percentage. And despite the capacity addition continuing over the next 2 3 years, we do not see that number significantly declining. So obviously, that's a well-balanced utilization between the growth that will happen on the capacity as well as at the same time, the underlying demand drivers will continue supporting the demand momentum in the sector. So we believe that the addition is actually well supported by the core demand that we see across the spectrum.
From a tariff point of view, how competitive are we at this point of time, and how much of a threat are, let's say, potentially lower tariffs?
Right. There are two parts to the overall trade dynamics when it comes to both the procurement of minerals or the raw material, at the same time exporting the overall finished product. The way we have differentiated ourselves with regards to our export potential and competitiveness is the lower cost of production. If you compare ourselves with Indian integrated steel players' cost of production vis-a-vis Chinese companies, we definitely have an advantage of lower cost of production because of multiple reasons, including the in-house stock and the availability of iron ore. What essentially happens is, while the tariff plays an important role with regards to trade dynamics, the view that you take up on the profitability, the example that I mentioned previously about some of these Chinese millers operating below the traditional average profitable line and getting down on their pricing, in fact, has pinched us to an extent with regards to our own dynamics in the global trade. However, when it comes to some of the major export destinations we have, for example, EU, we believe that the tariff with regards to CBAM notification will eventually come up from 2026 in a graded manner. But somewhere that quota mechanism which operates in that destination enables continuous exports from India to these countries.
Bottom line, we are reasonably competitive, at least in some markets.
Right.
Sehul, thank you so much for joining me.
Thank you.
Thank you for listening and your support for the Core Report. We've been streaming for a year, and we think this is a good time and ripe for a quick feedback from you on what we can do new and better on this podcast. And thank you, as always, for some good critical feedback. The link to a short survey is in the show notes. SRs never say never. Sticking to steel, the Mumbai headquartered Essar Group has said it's awaiting final approvals to start investing about $4.5 billion or over 35,000 crore rupees in building a low-carbon steel plant in Saudi Arabia. Its top official Prashant Ruya and promoter told the PTI. Now, these approvals are apparently expected anytime soon, after which the Essar Group will start working on a 4 million ton per year steel plant along with port facilities at Ras Al Khair in Saudi Arabia. Now, this project, of course, has been in the works for some time and was reported on last year as well. Now, this plant will apparently meet domestic steel demand in Saudi Arabia and is aimed at electric vehicle manufacturing factories among from other industries. Take about 3.5 years to build. The question, of course, could be, why is Essar investing overseas and not in India? Well, partly, of course, because there's an overhang. It had to sell its roughly 10 million ton steel plant in Hazira in Gujarat to ArcelorMittal and Nippon Steel in 2019 in an insolvency process. It also sold its 20 million ton oil refinery to a consortium led by Russian oil major Rosneft in 2018. Anyway, so now Essar says it's turned debt-free 2 years ago after selling all these infrastructure assets. So back to domestic steel, Prashant Ruya told PTI that he hoped for a re-entry to the Indian steel industry and is looking for an appropriate time to do that. According to him, it's an interesting space to be in, that's steel. They've done it for about 25 to 30 years, and once the opportunity comes, they will look at it. They're already trying to build a plant in Odisha for iron ore pellets, but it's not a full steel plant, he told the PTI. India's small enterprises want a slice of the PLI scheme. India's small and medium enterprises want a share of the government's production-linked incentive schemes or PLI schemes, which are usually aimed or targeted and picked up by larger enterprises. Now, this was part of a 10-point representation made by the Federation of Indian Micro, Small and Medium Enterprises or FISME, an umbrella body of about 740 associations across India, and was made to the Finance Ministry last week. A share of subsidies or benefits for production will obviously help create more jobs, though the administration of this could be somewhat tricky going by the experiences of larger companies who are also using PLI schemes to expand their manufacturing base. The FISME started in 1995 as the Federation of Geographical and Sectoral Associations of Small and Medium Enterprises in India, and its earlier avatar was actually born in 1967 as the National Alliance of Young Entrepreneurs. Back to now, the FISME wants a revision in the special mention account classification used by banks in their loans to them. This is, of course, similar to being declared a non-performing asset. In this case, the SMA or special mention account is triggered if principal or interest payments are delayed by 30 days. Obviously, once the red flag is raised, as every small entrepreneur knows, bringing it down is not at all easy. I reached out to Sandeep Jain, president of the FISME, and I began by asking him first for a mood check amongst small and medium enterprises, including his own company, which manufactures auto components out of Gurgaon near Delhi, and then a larger take on what the associations or the federation is looking for.
The auto component supply chain in India has been in the formal sector primarily and is very disciplined thanks to our OEM customers or pedigree of the Japanese for the last 35 years. So the mood is always upbeat and we get paid on time. We have good technology. We keep expanding all the time. So yeah, I mean, we are
And
happy.
the industry is seeing record sales. Yeah, so
Yes. So from my specific vantage point, things are good. Things could be better. And I think we are moving towards that. By and large, as a FISME president, what I hear from our members are also things are headed in the right direction. I may just add here that, MSMEs are diverse, not just in the sectors they operate in, but also in size. And we do club them just as in MSMEs, but what we need to keep in mind is that 99% of MSMEs are the micro, the really tiny ones. That is a difficult lot. Life is difficult for them. Business is not very easy for them. They are single mom and pop operations. And yes, so their needs, tribulations are very different from the S and the M, the small scale ones or the medium. And, starting with 99%, which is more than 6 crores, we come down to the mediums, which are just about 25, 30,000. And they are the ones who have the aspirations to grow large, and the small have the aspirations to grow medium. And therefore, whatever ask we carried to the FM for the pre-budget meeting was basically to allow the smalls and the mediums to grow further.
Right. So one of the things that you asked for is to extend the production linked incentive scheme somehow from the large enterprises who are currently benefiting from it to smaller ones. So how would that work? I can see the objective because obviously job creation.
Yes. So, we question the basis of choosing just a few products for allowing in the PLI scheme. Yes, they were established industries, not all, some maybe. Cars, okay, automotives, yes. But we feel, and we have told the FM in so many words, that we feel it is ad hoc or maybe lobby driven. Whereas, what does India need today? I mean, we need employment. That's the cry from all over. And MSMEs, you say and you agree, that are the largest employers in the country. So there is no PLI scheme for the MSMEs yet. And we do not ask for a product based, we ask for a system based one, which generates employment. In fact, we gave her a metric that you should consider employment generated per unit of cost or unit of expense, unit of capex. So that could be a metric which is used, and a PLI scheme that if there is an MSME that employs 100 people and employs 100 rupees, I mean, vis-a-vis another which may be employing few less, but maybe having a higher turnover, that doesn't work. So we should concentrate on jobs and employment-based PLI scheme. That is our request.
And is there a sort of administrative, logistical challenge in doing that, working with, let's say, a much larger base of smaller companies as opposed to maybe a few big ones?
Well, MSMEs would be very happy if something like that comes for them. Administratively, I do not know how the government would look at it because this suggestion was given to them only day before. But all I can say is that there were secretaries of the main departments, finance, TPIIT, and DEA there. They all took it very positively. I could see them nodding their heads, and even the FM did seem to like the idea as to why not. How it would come about, when it would come about, it's a little too early to forecast. But yes, the idea did attract them.
The other point that you've also discussed with the government is on the trigger that, if there are delays in principal or interest payments for MSMEs. Walk us through what happens and how, let's say, MSMEs are disadvantaged as compared to, let's say, larger companies.
So the whole import of our presentation to the FM was ease of doing business in India. And currently what is happening is that because of this new rule, not new, it's been there for a while, about system-driven approach to triggering NPAs or accounts which may be unsafe for banks. Let's say there is an account which has a loan and it is rated special mention account SMA rating 0, 1, and 2. And since it is system-driven, the computer just sees that, there is a delay in repayment. And just a few days delay in repayment classifies it as an SMA 0, 1, or 2. As a result, what had happened is now this system does not take into account the turmoil which is there today because of the wars or the COVID that has just passed us by. During COVID, we have real world examples, and we mentioned two of those very glaring ones. Award-winning companies, exporting companies doing very well because they delayed their repayment to the bank loan, the bank, just by a few days, just because the computer marked it as an SMA, the bank closed down the facility immediately. The account was frozen and the companies had no cash flow, and suddenly they had to closed down their business. The proprietors, the owners had to sell off their private properties to repay the loan. I hope that this kind of a thing is not there for MSMEs, because unlike larger companies which can take some of these kind of disruptions in their flow, they have more resources, though even larger companies suffered during COVID. But small companies, they operate on very, very small operative margins and cash flows. They get clobbered when things go wrong.
In terms of hierarchy of issues, so these I'm assuming are two important issues the association is now raising. I'm assuming goods and service tax or the delivery of it or the administration of it is another issue.
Not really. Well, not in the organized sector. And I think now it's been, 7 years. So even the smaller guys have kind of adopted it, used to generating e-way bills and accepted the new tariffs. So I don't see a problem there. Some of the issues which were mentioned in the pre-budget consultation were small issues which the FM asked the association leaders, which were either geographical or sector specific, to take it up with their local state GST councils. It was about confusion between how you look at mango pulp or mango puree. So syntax and semantics and that kind of a thing. But he was very clear that these are trivial things and you should, by and large, I have not heard of any major issue regarding either the tax numbers, the tariffs, the HSNs. So yeah, GST seems to be good. And you can see from the numbers that GST is generating every month.
Now, we've spoken of issues mostly in the realm of finance and the Ministry of Finance. Is there anything outside that concerns you, that's something that's bothering the association?
Or MSMEs, going finance is big. Ease of finance, ease of doing business go hand in hand. But yes, I will come to one more issue which FISME has suggested. One of our studies shows that, see, business is moving from the west to the east. In the sense, the data that has emerged shows that the eastern countries, southeastern countries, GDP in world trade by 2030 will rise to 60%, which currently is enjoyed by the West. And we suggested to her that we must start looking at East as a viable export destination on war footing, because all our export promotion activities, also whatever we do in terms of World WTO, etc., tie-ups that we do, are all directed toward the West. You're not looking eastward yet. So global GDP rises. We don't want to be left behind. So we should start looking at exports to the southeastern and far eastern countries.
Right, Sandeep, thank you so much for joining me.
Thank you.
That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in. And thank you once again for listening.